Welcome to the Thinking Director channel, where thinking differently leads to living differently. Hi there. I know it's getting late. Maybe you're winding down after a long day. Or maybe you're looking for a bit of insight before stepping into a new trading week. For me, the night is when the mind becomes clearest. No noise, no distractions, just thoughts and unanswered questions. Where is gold heading next week? Is the market reflecting reality, or just a stage crafted by the insiders? That's why I'm here, late as it is, not to throw numbers at you, but to share real experience, honest perspective, because if we walk into the markets with clouded judgment, we don't just lose money, we lose trust. This past week, the gold market played out a script that might one day be studied in financial textbooks. It opened with anxiety, built up to panic, and ended with a dramatic reversal that caught almost everyone off guard. Some couldn't sleep, haunted by regret. Some blew up their accounts because of a bad decision made just hours too early. But a few, just a few, saw the signal in time and pivoted before the storm hit. So the real question is, where were you in that story? This video isn't going to teach you elite technical analysis or how to get rich overnight. What I want is for us to reflect, slowly, clearly, on what just happened, and draw lessons that are real, practical, and personal. We'll walk through 9 chapters, each one a raw snapshot of the market. From the traps set by market makers, to the political agendas behind the headlines, from herd psychology to the hidden gems buried in chaos. And in the end, we'll ask a question that matters more than profit. How do we not just survive, but grow through these waves of uncertainty? If you're here looking for grounded learning, no fluff, no promises of fast money, you're in the right place. I won't promise you an easy road, but I can promise it'll be a clearer one. So let's begin with the week that just passed. A week where the price of gold moved on charts. Yes, but more than that, it stirred up the deepest questions about markets, psychology, and how we make decisions in a noisy world. Are you ready? Let's begin. If you only watched the market from Monday to Friday afternoon, you'd probably think, well, that was a brutal week. Gold opened with a red streak, plunging from the 3,440 range all the way down to 3,266 United States dollars per ounce. Anyone holding gold during that stretch likely went through a roller coaster of regret and frustration. Comment sections were filled with panic. Gold might drop below 3,200. Time to sell. Next week's gonna be worse. But here's the thing. Markets don't follow what the crowd thinks. In fact, they often move in the opposite direction, just to prove a point. At around 7:30 p.m. on Friday, a seemingly minor report was released. U.S. unemployment came in higher than expected. That's all it took. The dollar weakened, and just like that, gold snapped back. Not only did it recover, it shot up sharply past 3,350 and closed the week at 3,362 United States dollars per ounce. A sudden reversal, a violent U-turn, and for those who had short positions open, total wipeout. This wasn't just a price swing. It was a lesson served hot. Because the truth is, markets operate like a theater. And most investors don't lose money because they lack knowledge. They lose because they can't wait for the curtain to rise. They get bored, they get scared, they leave before the real show begins. You see, this market didn't reverse because of new information. It reversed because the big players, those with deep pockets and no emotional bias, knew exactly when the crowd would break. They waited until everyone sold. Then, with one piece of data and one well-timed move, they flipped the game. And if you were watching closely, if you had just a little patience, you would have seen it coming. Let me ask you, were you one of the people who reacted too soon? Or were you one of the few who waited long enough to witness the reversal? Don't take this question as judgment. Take it as a mirror. Because the better you understand yourself, the less you'll be swayed by the herd. And the more clearly you'll see that sometimes, the smartest thing to do is nothing. Markets don't reward noise. They reward those who can stay calm in the chaos. And last week, Friday night, was chaos at its finest. But to the few who were ready, it wasn't chaos, it was clarity. Let me ask you something. Have you ever felt like the market was putting on a show? Like every price swing, every headline, every sentiment shift, was part of a play you weren't invited to? Well, last week, you weren't wrong to think that. From the very start of the week, gold dropped aggressively. Negative news came out one after another. Mainstream media ran gloomy headlines. Gold could crash below 3,200. USD gaining strength again. The Fed will keep rates high for longer. And what happened? Retail investors panicked. Some sold. Some froze. Others cut losses just to get out. It looked like the beginning of a full-blown sell-off. But in reality, it was just act one of the play. Because behind the scenes, someone else was watching calmly. Waiting. The market makers. Now let's be clear, market makers don't mean some shadowy villain in a movie. It's a mix of institutions, hedge funds, central banks, major trading firms, entities with access to better data, deeper capital, and a longer time horizon than most of us. And what they did last week followed a textbook strategy. Create fear early in the week. Let the crowd sell out of emotion. Accumulate at a discount. Then flip the market on Friday, just when retail investors are too exhausted to react. They didn't predict the market. They staged it. If you study trading psychology, this entire sequence should feel familiar. Because markets don't move on information. They move on how people feel about information. And that makes crowd behavior incredibly predictable, if you know where to look. Here's the typical emotional cycle of retail investors. 1. Hope, this pullback is temporary. 2. Fear, maybe I should sell just in case. 3. Panic, get out now before it drops further. 4. Capitulation, I've lost enough. I'm done. 5. Disbelief, wait, is it going up again? 6. FOMO, why didn't I just hold? Sound familiar? That's because this playbook repeats over and over. And once you recognize it, you stop being part of the crowd. You become the observer. You stop reacting and start responding deliberately. So what should you take from all this? Don't try to outguess the market. Try to understand the game. The market isn't fair, but it's not rigged either. It just favors those who have discipline. And it punishes those who make decisions based on fear. So the next time you see a wave of panic sweep across headlines, forums, and social media, ask yourself, am I seeing reality? Or am I watching another act in the play? Because the market makers? They're counting on you to forget that this game is always scripted. While most eyes were glued to price charts and news headlines last week, something big happened quietly, almost too quietly. A Federal Reserve governor, one with voting power over monetary policy, resigned unexpectedly. She was supposed to serve until January 2026. Instead, she announced she'd be stepping down in August 2025, well ahead of schedule. No scandal, no press storm, just gone. Now, to the average observer, this probably looked like just another personnel change. But if you understand how power works in finance, you know better. Because that empty seat isn't just a chair. It's a voice, a vote, a signal. And it comes at a time when the political tides are shifting fast. Enter Donald J. Trump. Trump has made no secret of his views on the Federal Reserve. He's called out Jerome Powell, current Fed chair, on multiple occasions, labeling him stubborn, ineffective, and a threat to growth. Now, here's the thing. Trump can't fire Powell directly. But he can influence the shape of the Fed by appointing new members, people who align with his economic philosophy. And that empty seat? That's an opportunity. An opportunity to install someone dovish. Someone who prefers lower interest rates, faster growth, and looser policy. And if Trump wins a second term, that person could very well become the next Fed chair. It's subtle. It's strategic. And it's how power shifts, not with a bang, but with a quiet change in personnel. Why does this matter to you? Because when power shifts at the Fed, markets move. Gold, interest rates, inflation, all of it. You see, monetary policy isn't just about economic models. It's about who gets to decide the rules. And if those rules start changing, so does everything else. Let me paint the picture more clearly. A Trump-aligned Fed might favor lower rates to stimulate the economy. That would likely weaken the dollar. And a weaker dollar tends to push gold higher. So while everyone's busy tracking price levels and support zones, the real story might be unfolding inside closed-door Fed meetings in Washington. This isn't conspiracy talk. This is understanding how influence works. If you wait for policy to change publicly, you're already too late. The real investors, the ones who prepare early, watch the boardroom, not just the charts. And that's why this seemingly quiet resignation is anything but small. It signals a shift in tone, a crack in the armor, a power balance being renegotiated. The question now is, will you wait until headlines scream about it? Or will you read between the lines and get ready now? Because when the Fed shakes, even slightly, the financial world trembles. If we're talking about money, and especially about how governments spend it, we can't ignore Donald J. Trump. Because love him or hate him, there's one title he's earned without debate: the highest spending president in U.S. history. According to the Congressional Budget Office, during his first term alone, Trump oversaw over $8 trillion in federal spending. That's a record. Yes, the pandemic played a role. But even before COVID, Trump made it clear he's not afraid to throw money at the economy. Cutting taxes? Checkmark. Pushing massive stimulus? Checkmark. Running high deficits to keep the markets booming? Checkmark, checkmark, checkmark. His economic approach is simple. If it grows the economy, spend now. Worry later. But here's the thing. Every dollar the government spends has a cost. And when you overspend for too long, you start to feel the consequences. Rising national debt, inflationary pressure, and a gradual loss of confidence in the US dollar. That's where gold enters the picture. Because gold is the counterweight to reckless monetary policy. Gold doesn't print itself. Gold doesn't get voted into existence. Gold holds value, especially when fiat currency starts wobbling. Under Trump, as government spending surged, guess what else started rising? Gold prices. Investors knew what was coming. More debt, more dollar devaluation, and more demand for safe haven assets. Now, fast forward to today. Trump is positioning himself for a return. And if he does return, many expect him to repeat his playbook, only bigger. That means more tax cuts, more stimulus, less concern for the deficit, and pressure on the Fed to lower interest rates. In short, the perfect recipe for gold to explode. And remember, Trump isn't just a former president. He's a master of media. Every speech, every tweet, every offhand remark moves the market. If he starts pushing for looser policy again, if he fills the Fed with loyalists, if he ramps up government spending like last time, then gold won't just be responding to charts and technicals. It'll be reacting to policy. That's why understanding Trump's economic philosophy isn't political, it's practical. Because while most people argue about red versus blue, smart investors focus on green and how to protect it. Gold isn't emotional. Gold doesn't care who's in the White House. But gold absolutely cares when government spending goes off the rails. So as we look ahead, here's a simple idea worth keeping in mind. If Trump returns to power, and the spending floodgates open once again, then gold might not just rise, it could launch. And if you're already holding it, you might be one of the few who saw it coming. Let's clear up a common myth. Markets don't always roar before they rise. Sometimes, they whisper. And right now, the gold market is whispering. It's not crashing. It's not surging. It's simply consolidating. Over the past several sessions, gold has been hovering in a tight range, between $3.250 and $3.450 per ounce. For some, this looks like indecision, but for seasoned investors, this is a classic accumulation zone. Think of it like this. The market is catching its breath. It's filtering out the noise. It's quietly changing hands. Impatient traders, those looking for instant gratification, start selling. They assume nothing's happening, but behind the scenes, large players are gradually building positions. Because they understand, big moves don't start from chaos. They start from silence. In technical terms, $3.450 is acting as resistance, a level price has struggled to break. Above that sits $3.500, a psychological barrier and former all-time high. If gold clears that, the next real target is $4. But here's the catch. That breakout won't happen while everyone's watching. It'll happen after the crowd has gotten bored, distracted, or shaken out. This is the nature of what traders call smart money. It moves quietly. It doesn't chase. It accumulates when others hesitate. Let's go deeper. Gold is not weak right now. It's simply resting. It's shaking out short-term players, testing conviction, and waiting for the right catalyst. And that's exactly what a healthy market does before it makes a big move. Now, here's the important mindset shift. Don't confuse sideways movement with stagnation. Sometimes, sideways is preparation, and preparation leads to momentum. In fact, some of the biggest gold rallies in history were preceded by weeks, even months, of sideways price action. Let me leave you with this thought. Markets don't reward speed, they reward preparation. And right now, the gold market is preparing. Not for a dip, not for collapse, but for its next move upward, one that could define the next phase of this cycle. The only question is, will you still be here when it happens? Let's talk about something most retail investors overlook. The gold to silver ratio. It doesn't make headlines. It doesn't trend on Twitter. But it's quietly flashing a signal that only seasoned eyes are trained to catch. As of last week, the ratio stood at 90.8 to 1. That means 1 ounce of gold could buy you nearly 91 ounces of silver. Sounds technical? Let's break it down. Historically, this ratio swings up and down. When the ratio is high, above 80 to 90, silver is often undervalued compared to gold. When the ratio drops below 50, silver has typically outperformed gold. So what does a 90+ reading tell us? It says, silver might be gearing up for a run. This isn't just speculation. It's a pattern, played out time and again. When gold moves first, silver tends to lag. But once silver catches up, it doesn't walk, it sprints. Why? Because silver trades in a much smaller market than gold. That means even a modest flow of capital can create outsized price moves. It's more volatile, more reactive, and, when the timing is right, more explosive. Last week, while gold rallied hard off the unemployment report, silver barely blinked. But that's typical. Silver always moves later. It waits. It builds pressure. And then, when most people have stopped watching, it erupts. This is why smart investors track the gold to silver ratio like a compass. They know it doesn't tell you when to buy, but it tells you something even better. Where opportunity might be hiding in plain sight. So here's the takeaway. If you already hold gold, you might want to consider allocating a small portion of your portfolio to silver. Not because gold is done, but because silver's turn might be next. And when it runs, it doesn't ask for permission. Think about this. Gold is the king. Silver is the wild younger brother. Gold moves with grace. Silver moves with speed. And in bull markets, sometimes the younger brother steals the show. Don't wait until headlines scream, silver up 30% in a week. By then, the opportunity will be gone. Look at the ratio. Listen to the silence. Read the signs. Because the market whispers before it shouts. And right now, silver is whispering, I'm next. Let me ask you this. Have you ever seen a simple news headline spark absolute chaos? A slight change in unemployment data. A Fed comment that might hint at future rate cuts. A rumor on social media. And suddenly, the market panics. Gold dumps. The dollar jumps. Investors react like it's the end of the world. But here's the uncomfortable truth. It's not the news that moves the market. It's how people feel about the news. Last week was a perfect case study. A Friday jobs report showed higher than expected unemployment. Was it catastrophic? Not really. But it felt like a signal. And that feeling alone flipped the entire market. Why? Because most people aren't trading based on facts. They're trading based on narratives. And narratives are emotional. Here's how market makers use that against you. They know when retail sentiment is shaky. They know when fear is peaking. So what do? They release neutral information at just the right moment, when the crowd is emotionally vulnerable. Not to inform you, but to influence you. The formula is simple, and it's used again and again. 1. Early in the week, feed the fear. 2. Midweek, stir doubt with subtle data points. 3. End of the week. Drop a headline that flips the narrative. 4. Boom, the market reverses. And most traders are caught on the wrong side. By the time retail traders react, it's already too late. The move has happened. The bait worked. Now here's what's scarier. You don't even realize it's happening. Because it feels organic. It feels like you made your own decision. But in reality, you were nudged. Nudged by timing, by tone, by carefully released information designed to trigger your deepest fears, or your deepest greed. That's why the real winners in this game don't obsess over every news update. They watch how the crowd reacts, not what the news actually says. They understand that most people follow this emotional cycle. Hope, excitement, doubt, fear, panic, regret. And once you see that pattern clearly, you stop being part of the herd. Here's the takeaway. Don't let headlines manage your emotions. Don't trade because you're scared or overly excited. U.S. unemployment came in higher than expected. That tiny data point flipped everything. The dollar weakened, momentum shifted, and suddenly, gold launched. From $3.266 to over $3.360 in just hours. What looked like a terrible week turned into a green weekly close. This is why experienced traders always say, never judge a market until the weekly candle closes. Because one session, one final push, can rewrite the entire narrative. Last week, Friday didn't just change the charts. It changed the energy, the tone, the confidence. It sent a message. Buyers aren't gone. They were just waiting for the panic to exhaust itself. Let's step back for a moment. Imagine a boxer getting knocked down in round 1, only to come back and win by knockout in the final round. That's what this week felt like. And if you left the ring early, if you sold out on Thursday because it looked hopeless, you missed the comeback. Here's the lesson. Markets can change in a flash. And most of the time, they change right when you give up. That's not just coincidence. That's how market psychology works. Because by the end of a bad week, most traders are tired, emotionally drained, out of capital or out of conviction. And that's exactly when the reversal comes. So the next time you feel tempted to quit early, to walk away because nothing's working, ask yourself, is the story really over? Or am I just too tired to wait for the final scene? Because if you had waited just one more day last week, you'd have seen it, not just a bounce, a turning point. Let me close this part with a reminder. One session, one shift in sentiment, one final move, can redefine an entire week. Stay alert. Stay in the game. Because when change comes, it doesn't knock. It kicks the door in. Let's talk about something most traders overlook. Not just where the price is, but where the price has settled. Because in markets, there's a big difference between a price spike and a price floor. Over the past few weeks, gold has spent most of its time hovering between $3.250 and $3.450. To some, this is just noise. But to those paying attention, this is a new normal. A few months ago, $3 was considered expensive. Now, anything below that feels like a bargain. That's not by accident. That's psychological anchoring. When the market spends enough time at a price range, traders start to accept it as fair. And once that happens, it becomes a launchpad. The longer gold holds above $3.250, the stronger the foundation for a breakout beyond $3.500. And once $3.500 breaks, we're no longer in familiar territory. We're entering the golden supercycle. So what is a supercycle? It's not just a short-term rally. It's a multi-year phase where a commodity enters a structural bull market. Driven not by hype, but by real-world forces. Persistent inflation, government overspending, central bank gold accumulation, geopolitical instability, and declining faith in fiat currency. And guess what? All of those forces are in play right now. Central banks around the world have been buying gold at record levels, the most in over 55 years. They're not buying because it's shiny. They're buying because they don't trust fiat anymore. Because gold is no one's liability. It doesn't default. It doesn't inflate. It just holds. So while the public debates whether gold is overvalued, the people with power are accumulating silently, quietly, steadily. Now let's zoom out. $3.250 $3.450 is the accumulation range. $3.500 is the psychological breakout level. $4 is the target of the next wave. But that next wave won't wait for a green light. It'll come when enough people have gotten comfortable and complacent. That's how breakouts always happen. Not when everyone expects it, but when everyone stops paying attention. So what should you do? Don't try to time every tick. Don't chase every dip or rally. Instead, ask, has the market accepted this price as the new baseline? If the answer is yes, then you know what comes next. The base becomes the springboard. And when that happens, your job is simple. Be in position, be patient, and let the market do what it's been preparing to do all along. Let me leave you with this. Markets don't explode out of weakness. They explode out of strength that's been underestimated. Right now, gold isn't just holding its ground. It's laying the groundwork. And soon, that ground might become the launchpad for a move that takes years to play out. You don't need to be perfect. You just need to be there when it happens. Let's take a breath. You've just walked through a week that looked like chaos. But now, looking back, you can see the shape of it. The rhythm, the design behind the noise. We've talked about the traps set by market makers. The emotional games built into every headline. The signals hiding in silver. The slow, silent building of a new price floor. And the power players reshaping policy from the inside. But above all, we've talked about how to stay standing when the market does everything it can to make you fall. And now, we come to the most important question. Building, really? What does all this information mean if it doesn't change how you think, or how you live? Because here's the truth. We each get one life. One body. One mind. One stream of money. The question isn't how much you earn. It's whether your money is working for you. Or whether you're forever chasing it. Gold won't make you rich overnight. It's not a meme stock. It doesn't scream for attention. But it holds something deeper. Discipline, patience, resilience. And those aren't just investment strategies. They're life strategies. Because when you learn to hold gold through turbulence, you're also learning to hold your conviction, your vision, your values. There will always be noise. Always be panic. Always be a new reason to give up. But the people who win, in markets and in life, are the ones who can breathe through the storm. They don't get tricked by headlines. They don't jump ship at the first sign of pain. They think in decades, not days. And that mindset? It's rare. It's valuable. And it's yours, if you choose to build it. So wherever you are right now, whether you're up, down, confused, or calm, just remember, you don't need to chase everything. You just need to move with clarity. One step, one decision, one stream of money, flowing in the right direction. And if you've made it this far into the video, you're already different. You're not watching the market like a gambler. You're studying it like an architect. You're building something. And that is how everything begins. Headphone, thanks for spending this time with me. If you found value in this journey, don't forget to like, subscribe, and share this video with someone who needs to hear it. We're not just talking about gold. We're talking about how to live and grow through the uncertainty. See you in the next video.